mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome everyone to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some more Ask James questions of the day. So our first question comes from Jill. She says, I'm just a few years out of retirement, but I'm currently invested in the Magnificent Seven, and they're doing well right now. And I really enjoy seeing the gains. Why is this so wrong if I'm a few years out from retirement? Well, Jill, if you're significantly behind in your retirement savings, which doesn't seem to be the case since you're only a few years out, then maybe a more aggressive growth-only approach might be necessary. But assuming you're on track, let's discuss why this strategy might be risky. First, it sounds like you're experiencing FOMO, fear of missing out. Remember when you were younger and you'd force yourself to go out on Friday nights even when you were tired, just because you didn't want to miss something? Well, FOMO can affect our investment decisions too, especially when we see others making big gains. However, as we approach retirement, our investment strategy needs to mature, just like our social habits have. Just as you might now prefer a quiet night in over a night out, your investment strategy should prioritize preservation and income over chasing the highest returns. The Magnificent Seven stocks, typically referring to Apple, Amazon, Alphabet, which is Google, Meta, Microsoft, Nvidia, and Tesla, have indeed performed well recently. But remember, past performance doesn't guarantee future results. These tech-heavy stocks are among the most volatile in the market. They can turn on a dime. We saw that in the dot-com bust of 2000. So consider this. The market was underwater from 2000 to 2007, and then again from 2007 to 2013. That's 6 and 7 year periods of negative or flat returns. If you're planning to retire in less than 7 years, a similar downturn could seriously impact your plans. Moreover, these stocks are growth-focused rather than income-generating. As you approach retirement, you should be transitioning towards investments that provide reliable income streams. Dividend-paying stocks, bonds, REITs, and other income-focused investments can provide more stability and cash flow in retirement. Don't fall into the trap of thinking you'll sell these stocks as soon as they start to turn. When they drop, it's tempting to hold on, hoping they'll bounce back. This can lead to larger losses. Instead, consider gradually transitioning your portfolio. Start moving into more diverse income-generating investments. Look for stable companies with a history of consistent dividend growth. Consider adding some bonds to your portfolio. They can provide steady income and help balance out stock market volatility. Look into REITs, real estate investment trusts, which can offer good income potential. So don't completely abandon growth. You still need some to combat inflation, but perhaps limit it to a smaller portion of your portfolio. Now, consider speaking with a financial advisor who specializes in retirement income planning. Now, they can help you create that diversified portfolio that balances growth, income, risk appropriate for your retirement timeline. Remember, the goal in the years leading up to retirement isn't necessarily to maximize returns, but to secure the nest egg you've built and ensure it can provide the income you need throughout your retirement years. It's great that you've seen gains, but now might kind of be the time to lock in some of those gains and reposition your portfolio for the next phase of your financial life. The transition from accumulation to distribution requires a different mindset and strategy. Don't let FOMO jeopardize the retirement security you've worked so hard to build. That is a fantastic question. As always, if you'd like to send in your questions, you can do so by emailing them to poollocke@poollocke.com. All right, great. Let's move on to our second question here. So this question is going to come from Kenny. Thanks for emailing in. Kenny says, I'm retired, but I really want my cake and I want to eat it too. I understand the income message, but I still want growth. Okay, Kenny. Now this is a common misconception that you have to choose between income and growth in retirement. Many people think that if they focus just on income, they're sacrificing growth potential, often because they're thinking about low-yielding investments like government bonds or bank CDs. But the truth is, you can have your cake and eat it too, to an extent. Let's explore some strategies for an income-first, growth-second approach that doesn't completely sacrifice growth potential. Number one, you can reinvest excess income. So if you're generating more income than you need for your living expenses, you can reinvest that excess. This allows you to stay conservative with your principal, often in bonds and bond-like instruments, while still achieving growth through reinvestment. It's the old-fashioned way of compound interest, buying more shares with your interest and dividends. Number two, high dividend equity approach. Now, this strategy involves focusing on stocks that pay higher dividends. Now, these tend to be value stocks rather than growth stocks like the Magnificent Seven tech companies. Historically, value and growth approaches have performed similarly over the long run. With high dividend stocks, you're getting regular income plus the potential for capital appreciation. You can balance your portfolio. Right? It's another choice here. You can create a portfolio that includes both income-generating assets and growth-oriented investments. The ratio depends on your specific needs and risk tolerance. Dividend growth stocks specifically look for companies with a history of consistently increasing their dividends. These often provide a good balance of current income and future growth potential. Real estate investment trusts are another option. These can offer both steady income and potential for appreciation, giving you exposure to the real estate market without directly owning property. So that's REITs. Preferred stocks. These typically offer higher yields than common stocks and can provide a middle ground between bonds and equities. You can use a covered call strategy. For those comfortable with options, writing covered calls on stocks you own can generate additional income while still allowing for some upside potential. You can use a bond ladder. Creating a ladder of bonds with different maturities can provide regular income while allowing you to reinvest at potentially higher rates as bonds mature. Remember, I call this an income first, growth second philosophy for a reason. The primary goal is to ensure you have the income you need in retirement, but that doesn't mean completely sacrificing growth. This approach is particularly important given increasing life expectancies. You might need that growth to cover healthcare costs, combat inflation, and fund a potentially longer retirement than previous generations. It's also worth noting that what constitutes growth in retirement might be different from your working years. You're not necessarily aiming for aggressive capital appreciation, but rather steady, sustainable growth that at least keeps pace with inflation. Lastly, don't forget about the power of the total return. Sometimes it makes sense to sell a small portion of your investments for income rather than relying solely on dividends and interest. This can allow you to maintain a more diversified portfolio. The key is finding the right balance for your specific situation. Consider working with a financial advisor who specializes in retirement income planning. They can help you kind of create that personalized strategy that provides the income you need while still keeping you in the game for potential growth. Remember, retirement planning isn't about maximizing returns at all costs. It's about creating a sustainable, reliable income stream that allows you to enjoy your retirement with confidence. Thanks for the awesome questions today. As always, if you'd like to send in your questions, you can do so by emailing them to poollocke@poollocke.com. If you like what you heard, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source. See everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in